Hey, Jason here. Today I want to introduce our new series to you, Uncommon Investing Terms. Uncommon Investing Terms, our new series. In this series, we're going to be talking about, of course, uncommon investing terms, why they're important for you, what they mean, why they're important for the investment analysis, how you can gain a huge advantage in some cases knowing what these mean, how you can avoid potential red flags by knowing what these mean and what these show for companies. You'll learn all that and more in this brand new series. Hey, Jason here. In this episode of Uncommon Investing Terms, today we're going to cover write-downs. A couple of weeks ago, we talked about impairments. Today we're going to talk about its cousin, write-downs. For context to this video, you'll probably want to go back and watch the impairments video. They are very similar, and next week we'll talk about the differences. So if you want to understand the context of everything, you want to watch these three videos in conjunction with each other when they're all released next week. Okay, so write-downs. A write-down is an accounting term for the reduction in the book value of an asset when its fair market value has fallen below the carrying book value and thus becomes an impaired asset. The amount to be written down is the difference between the book value of the asset and the amount of cash that the business can obtain by disposing of it in the most optimal manner. Again, like all these kind of definitions, what the hell does that mean? That's convoluted. It doesn't really make that much sense unless you break it down. So in a real world sense, think of write-downs as very similar to impairments. When an asset you own becomes worth less over time, or because you overpaid for it, or because markets have changed and you're not earning as much cash flow from it, those kind of situations, you have to write down an asset. Again, this is very similar to impairments, and again, I will talk about the differences between these in next video because these definitions sound very similar, and they are very similar. Frankly, most of the time when you read a financial statement, you'll see write-downs and impairments kind of used interchangeably. So there isn't large differences, but there are nuances to it, which again I'll talk about next week. So what's an example of why this is bad? So very, very similar to why impairments are bad. This reduces book value, typically because you write down the asset. Let's say you write down accounts receivable, and you figure out you're not going to be able to, let's say a recession hits tomorrow and your clients say they can't pay their bills that they already agreed in contract to pay you. You'll have to write down the value of your accounts receivable, let's say by 50%. Let's be more realistic. Let's say 25%. You have to write down that value of the accounts receivable, which will lower the book value of the company, which again, we use book value as a kind of very basic proxy of intrinsic value of the company. So it lowers the book value of the company. Most cases lowers the intrinsic value of the company. Both things lower the margin of safety that you have in the investment because its balance sheet is not as strong, and it will almost always lower the stock price as well. So all these things will kind of happen in conjunction when you write down an asset. Another thing you need to consider is, I'm kind of scanning this, is okay, impairment. We're not talking about impairment. Okay, so this means this is similar to reproduction value, which we've talked about in other videos. Reproduction value is essentially the value you could get if you had to sell something, or if you had enough cash to have on the balance sheet to reproduce another company's operations. This is a similar statement. So this is essentially saying the difference between book value and the amount of cash the business could obtain. So the difference between what it's worth on the balance sheet and what you could sell it for, let's say, again, a recession happens and your customers can't pay their bills, you'd have to reduce that amount by, again, in the previous example, 25%. Nothing else. Okay, that's an example we already went over. Here are some common assets that are written down: goodwill, accounts receivable, inventory, property, plant, and equipment. So for example, let's say you're a manufacturing company and you own a lot of equipment that's 20 years old. It probably doesn't have much value today because technologies move so fast. So that probably would have to be written down on the balance sheet, again, which would lower the value of the company, all that. Another thing, just as I was scanning, I saw that this is something you need to watch out for. So let's say you have new management, you have a new executive team coming into a company, and they immediately announce, or their first quarter's earnings, they announce just an awful, 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 awful quarter that nobody expected out of nowhere, and it's just horrific. Like earnings are down like 50%, something like that. Companies will do this. They will write off assets in some cases when they come on board to make future earnings look better. So again, if you want to read this whole thing, you can. But this is, I learned this back in the book Financial Shenanigans, which I read originally years ago, and then I reread the 25th anniversary edition last year. And companies still do this to this day. They write down assets, or they sell assets, or they do stuff with the assets on the balance sheet to make it look like, they get everything done in one big quarter. They get all of the terribleness out in one quarter, which is why it's called big bath accounting. You throw everything in there, even stuff you don't necessarily want to throw in there, to make that quarter really bad so your next quarters look really good. It's a massive red flag if you see that. Obviously, it's manipulating, which this says right here. It's a way to manipulate the company's earnings, which, again, if the company is doing that, they're not doing what's in shareholders' best interest. So that is a massive red flag, something you need to look out for. Most of the time, you don't see write-downs that are hugely important, except for at big companies. Big companies, because they buy a lot more companies, or they buy assets a lot more, and oftentimes other companies. You'll see impairments and write-downs quite a bit at bigger companies. For smaller companies that I typically focus on, you don't see impairments and write-downs a lot. But again, these are two very, very, very important terms, because if you do see a company having to impair or write down a lot of assets, I can't remember the company's name off the top of my head, but I did a case, Kraft Heinz. I did a case study on that. Again, I'll link that below, where I talked about their impairments. If you want further context on impairments and write-downs, you need to watch that. If I remember right, there were $16 billion total in impairments and write-downs, which just trashed the stock, because, again, it lowered the book value of the company, lowered the underlying asset value of the company, and all that. The stock just got trashed. So this is a very important thing to watch out for, especially if you invest in bigger companies. In smaller companies, you don't see it as much, but it's still, if you see this on even a semi-regular basis, or if it's one big time and it's an enormous amount compared to the market cap, you need to be very wary, and you need to dig into the footnotes in the financial statements to figure out what's going on, to see if this is a one-time thing, if this is a long-time kind of strategic issue, if this is going to wreck the company's balance sheet completely and trash the stock, all that kind of stuff. You need to figure out all that kind of stuff if you do see impairments or write-downs. If you have any questions about write-downs or impairments, let me know. in the comments below, because again, these are two very important concepts. Next week, we're going to talk about the differences in impairments and write-downs. And again, I'll link the previous videos in this series below, specifically the one on impairments, and also the video I did last year on Kraft Heinz analyzing their impairments as well. So a case study I did on them about their impairments and kind of just analyzing, doing a brief analysis of their stock to see if it was still undervalued. So I'll link all that below. If you have any questions, as always, let me know in the comments below. Until next time, I'll talk to you again soon. Have a great day.